Okay.
Got it.
Okay.
Thank you. Great. So before we get started, hi everybody. I'm Erica Markin, Development Director here with Utah Clean Energy. And I just want to say how grateful we are to you, Jean, for joining us today and sharing your expertise and insights, not only on, being able to help save folks on their taxes, but also doing good at the same time and really being able to kind of maximize both saving taxes and support for their favorite charities. So thank you again, Jean. We just are so appreciate you being here. And with that, I'll go ahead and turn the time over to you.
Okay, first I'll point out in the ceiling is our brand new heat pump system that was just installed this week. So we hope to be getting the Inflation Reduction Act tax credits. And we also got a heat pump, hot water heater. So, all right. I'll introduce myself. I'm Jean Lown. I always tell my students my last name rhymes with town, very simple. A little bit about my background experience. I have 40 plus years of teaching and research in the areas you can see listed there. And we'll be talking mainly about the investing and retirement aspects today. I also taught a monthly financial planning for women workshop, and I've do some informal financial advising where I have my clients donate to 501c3, typically one that's related to climate, because that's my main concern. And so I've had lots of experience. I've had over 100 clients, dealing with these types of topics. So thanks to Utah Clean Energy for inviting me. You're probably all familiar with Utah Clean Energy, and I can't wait to see your new building. Don't get to Salt Lake all that often, but I have heard about it and read about it, seen some photos and such, and so I'm anxious to see the building. So our topic's going to focus on how to donate to nonprofits while saving taxes using retirement account funds. And this process you can use as early as age 70 and a half. And so once you reach that age 70 and a half, you can take advantage of making donations directly from your qualified retirement account to a nonprofit charity, as long as it's a 501c3. So we're going to be talking about QCDs, or qualified charitable distributions. And this enables you to make the donations while saving on taxes by having the donation go directly from your retirement account to the 501c3. You do not receive the money yourself. It is directed directly from your retirement account. Then once you reach age 73, you can use these QCDs to satisfy your required minimum distributions. And the bottom line is that you can donate more because you're not paying federal and state income taxes on your withdrawals. And normally, if you were to withdraw money from your retirement accounts, the money would come to you, and then you would write a check to the charity or the nonprofit. Well, you would pay taxes then. So how to avoid paying those taxes? Whoop. So first of all, we're not talking about Roth IRAs, because your Roth IRA withdrawals are tax-free. You paid taxes when you contributed to the account. Of course, you can donate from your Roth, but there's no tax advantage to doing that. And essentially, Roth IRAs do not require any withdrawals, so they're not covered by required minimum distributions. No withdrawals until after the donor's death. And so if you were to inherit a Roth IRA, then you would have to pay taxes. So we're focusing on tax savings from your taxable retirement accounts. So once you reach age 70 and a half, and why 70 and a half? Well, it's like the 59 and a half, Congress makes these decisions and there's no, real explanation of why not 70, why not 71. So if you have these types of accounts, like a traditional IRA, 401k, et cetera, with all these accounts, you contributed with pre-tax money. And if your employer contributed, they got a tax break for contributing. So all the decades that your funds were growing, they grew tax deferred. So the withdrawals are usually taxable when you take the money out in retirement. And the exception is that when you donate to a 501c3 directly from the retirement account, you can avoid paying both federal and state income taxes. So the qualified charitable distribution, it's non-taxable, made directly from the trustee of your account to a 501c3. Again, this is something you can use when you're age 70 and a half up to age 73. And at age 73, your required minimum distributions are mandatory. So we'll talk about that. But before age 73, you are not required to take money out of these retirement accounts. And there is a maximum. So the maximum that you can contribute is $105,000 per year. And this amount is adjusted periodically for inflation. So, you might have $1 million in your account, but in a single year, you can't make qualified charitable distributions for more than $105,000. So this age bracket from 70 and a half until right up to when you become 73, your QCD must come from a traditional IRA. Now, there's no logical reason why it can only come from a traditional IRA. We're not going into that. Who knows what Congress was thinking? So you might say, well, I don't have a traditional IRA, but you can open one, or you can increase the amount of money that's in your traditional IRA by transferring funds from your other tax advantage retirement accounts. So this is one thing that I've done in order to be able to increase the amount of QCDs that I donate each year, is I simply had money transferred from a 403B to my traditional IRA. And even though they were with separate mutual fund companies, it was a pretty easy process. So if you're in this age bracket of 70 and a half to 73, you don't have a traditional IRA, you can easily open one, and it would be logical to open it with the same administrator or the same mutual fund company where your other retirement accounts are. Once you hit age 73, Congress allows a lot more flexibility. So here's a tax saving example. Let's say you were making $1,000 contribution through a QCD. And here's an example if you were in a 22% federal marginal tax bracket. Now, our federal marginal tax brackets range from 10% to 39%, but I'm just picking kind of a mid-range bracket there. And Utah's flat tax bracket is 4.55%. So if you were to withdraw funds from your taxable retirement account to donate to charity, you'd owe 22 plus 4.55% or $265 in both federal and state income tax. If you simply made that withdrawal, had it deposited, say, in your checking account, and then wrote a check to charity. If you were in a higher tax bracket, like 35%, with the federal taxes plus the 4.55% Utah tax, you'd owe $395 in tax. So once you become aware of this, it can suggest that, the charity would still get the $1,000, but maybe you'd be willing to make a slightly more contributions because you're not paying that $265 or $395 in taxes. Okay, so once you hit age 73, the options for making qualified charitable distributions expand. At age 73, you're required to make minimum distributions, to take money out of those accounts. Because when you and your employer contributed to those tax-deferred accounts, you benefited from an initial tax break. Your contribution was not taxed, and you enjoyed decades of tax-deferred compounding. So you postpone taxes on your contributions initially and on the earnings and growth over the decades. So Congress doesn't want people to, the wealthy, doesn't want the wealthy to pass these funds tax-free on to the next generation. So at age 73, they decided it's time to pay taxes. Now, this age has increased. It used to be 72. So, now it's 73. Okay. So these required minimum distributions are the minimum that you need to withdraw from your non-Roth retirement accounts each year. So IRAs, 401ks, SEP, the simplified employee pension, the simple IRA, other retirement accounts, you have to start making withdrawals from each of those accounts. And if you fail to take these withdrawals, the IRS will slap you with a 50% penalty on the amount that you should have withdrawn. So let's say you were supposed to withdraw $5,000 in the first year, and you weren't aware, or you neglected, you failed to withdraw that amount. They will slap a 50% penalty, or $2,500 that you need to pay for the IRS. And sometimes it happens that people neglect to do this for a few years in a row, and then the IRS starts charging interest. So you want to make sure that when you hit age 73 that you're aware of RMDs and are withdrawing that amount. These are, some of the accounts that are affected by RMDs. So we've gone much beyond the traditional IRA account. Now, if you had inherited a Roth IRA, you are a beneficiary of an inherited Roth IRA, then you are also need to take required minimum distributions. So again, one of these convoluted requirements. The latest date to take your first RMD is by April 1st of the year following the calendar year in which you reach age 73. But if you were to reach 73 in 2004 and you say, oh, I don't really need the money, I'll wait until next year because I have until April 1st to make the withdrawal. Well, no, that's not a good idea, because then you owe 2 years of RMDs. So, do it in the year you become 73, even if it's on the end of December of 24, sorry. And the IRS has tables that are designed to deplete your accounts by your death. And the idea is that your percentage of your account that you need to take as an RMD increases every year. so that in theory, you will have withdrawn from these accounts during your lifetime. Okay. Now, if your money's in a mutual fund company, your account administrator should calculate your RMD and notify you. But when I was practicing with a couple of friends and given this presentation, one of my friends said that her husband had neglected for 3 years in a row to take his RMD, and thus ensued a lengthy battle with the IRS about the penalties. So you can choose how to withdraw your RMD. You can take it all at once on January 1st or in any amounts during the year. You can set it up so that you will get your total RMD in regular monthly or quarterly distributions, or you can take it through QCDs. And of course, a QCD counts towards your required minimum distribution. Now, I have that little red asterisk by the regular monthly or quarterly distributions. Now, if you take this option and your account administrator says, okay, you owe, say, $5,000, and we will distribute that each month to your account, well, then you can't really use the QCD option. But you may have 3 or 4 different retirement accounts, and you may choose to take your QCD in a monthly or quarterly distribution in one of your accounts and not the others. But if you take all your RMDs that are automatically deposited in your checking or savings account each month, then the money has come to you and you can no longer use the QCDs, because the money for a QCD, in order to save on those taxes, must not come into your hands. Now, here's an example of a table with required minimum distributions. I just used the example of $100,000 in the account because it's a nice even number. And if you look down the left-hand column, ages, you might be amused to see that the tables that the IRS uses actually go up to 120 plus. Now, we're not expecting any of us to live that long. But you can also see in the next column, the RMD increases gradually as you get older, with the idea that if you're 95 and you still have $100,000 in your account, that they'll be requiring you to take out, and of course, you can do whatever you want with the money, but they'll be requiring you to take out larger amounts as you get older. And you can see, by the time you're 120, they expect that you'll be taking out at least half the amount there. Then in the next 3 columns, I've just picked 3 different, I told you that marginal tax brackets at the federal level range from 10% to 39%, but I've just selected 3 different tax brackets there. And what I've calculated from the table is, if you're 73 and your RMD on that $100,000 is $3,774, if you were in a 12% federal marginal tax bracket plus the Utah state income tax, the amount of tax that you would pay on that withdrawal is $624. And if you're in a higher 22% bracket, the combined federal and state income tax would be $1,000 at 1,002. And so you can see, for wealthy people that are in a really high tax bracket, like 37%, it's only really high by recent standards. Back a few decades ago, when I was first teaching, the highest tax brackets were up around 90%. But that's just a little history. So you can see that the higher your tax bracket, the more incentive there is to avoid those taxes. And, so that gives you a general idea of how the amount of your RMD increases. Now, you might say, well, if you had $100,000 in your account when you were age 73, you're not likely to still have $100,000 in your account by the time you're 90 or 100. Well, it all depends on how your money is invested and what's happening in the investment markets. Because there's plenty of academic research that shows there are terrible years in which to retire, and there are excellent years in which to retire. And for people who are retire at the right time, which of course you cannot know ahead of time, and they're taking out money to, fund their retirement, and yet their investments may grow faster than their withdrawals. They may die with the same amount of money in their account as when they first started 30 years earlier. But that's just a little aside about some of the academic research. And you can't know when you retire whether it's going to be a good time or a bad time. We can only look back in history. Okay, so how do you actually do this? Well, I'm using the example of, say, of your retirement money is in mutual fund. So you simply search for QCD in the search box on the account website, and it'll tell you, explain how to take your QCD, and you click on the little box that says, I want to do this. You identify the source of funds to sell. And here I'm thinking about, you have a retirement account, but let's say 60% of it's in a stock mutual fund and 40% is in a bond mutual fund. Just kind of a classic distribution there. You decide where to take the money from. Now, just as a little bit of an aside, you should look at what the different mutual funds within your account have been doing and sell that which has grown the most. People tend to want to sell if they see the red ink and they look at, oh, that account hasn't been doing very well, I should sell that. No, no, no. Buy low, sell high. Okay, so you identify the source of the funds to sell, and then you specify that the check is to go to a nonprofit, not to you, and you type in the name of the nonprofit charity. And depending upon your account administrator, which mutual fund that you are invested in, they mail that check. They may mail the check to you directly, and then you have to then mail it to or take it to the charity. Or some companies will send the check directly to the nonprofit, which is, of course, more convenient for you. But it all depends upon who you have your funds invested with. T. Rowe Price, Vanguard, TIAA, fill in the blank there, Fidelity. So each company might have a slightly different process. Now, a reminder that you may have more than one retirement account. Your RMDs are calculated separately for each account. And the charity should still send you a mailed donation on paper with the acknowledgement. Keep those for your records. And then, again, a reminder about that 50% penalty for failure to make your RMDs in a timely fashion. So again, as I talked about recently, depending on when you retire, your accounts may be depleted before you die, or the account values may actually increase if the investment markets are very favorable while you're in retirement. So to summarize, use QCDs to make charitable contribution dollars go further. Theoretically, you can donate more because you don't pay taxes on your charitable contributions. So make your charitable contributions to 501c3s through a QCD rather than taking withdrawal from your retirement account and then writing a personal check to the charity. And again, that check must go directly from your account administrator to the 501c3. The earliest that you can use these QCDs is age 70 and a half. And at age 73, you can continue using QCDs, but at age 73, they can be used to satisfy part or all of your required minimum distribution. And, I've had some clients complain about, well, we have plenty of money from Social Security and a pension, and we don't really want to take these RMDs. And I kind of laugh and say, well, that's a terrible problem to have. So, I can suggest using that money to make a charitable contribution with a QCD. Other uses, solar panels, heat pumps, like we just did to replace our gas furnace and AC, heat pump to replace our gas water heater. Insulation, energy efficient windows and doors, electric vehicles are becoming a lot more affordable. I'm a regular reader of the Wall Street Journal, and I've read that new and used electric vehicles are becoming a lot more affordable than just a few years ago. So, if you're in the situation where, oh my gosh, I've got so much money, I don't want to really take those RMDs, take the money because otherwise you'll be penalized. And then questions, comments?